Thank you, and again, welcome all of you to Fundamentals of Single Family and Rental Housing Finance. The webinar today is a 2-hour webinar, but we will have plenty of time for questions, not only after the webinar, but during the webinar as well. The webinar today is designed to help you become familiar or refamiliarize yourself with some of the terms and concepts that you learned in the HD 410 and HD 420 class. We're also going to introduce to you the spreadsheets. We're not going to go in depth in the spreadsheets because that is really the purpose of our HD 422 computer spreadsheet class, but we'll introduce and go through a few of the things with the spreadsheet, show you how information can be entered and assumptions can be changed to quickly get results. With that in mind, I want to go over how you need to ask questions, and you can do that as a verbal question by selecting the hand icon on the right side of your screen, and then you'll be placed in a queue, and once you're identified in that queue, we'll ask you to unmute your line, and you can ask your verbal question. Once you've asked your question, if you'll go ahead and deselect the hand icon and make sure your line is muted again. You can, of course, ask a written question at any time in the Q&A box. Just write your question there and send to all panelists as instructed by the WebEx producer. Let's go to our housing finance and a little bit of what we've covered in our previous classes. In the housing for homeowners, we basically took you through the process of financing the development of the project, financing the construction of the units, and then determining whether you could sell those units for enough to cover your construction cost and still provide a reasonable return to the developer, or whether you had a financing gap and there was a need for a development subsidy. We also looked at financing the buyer of the individual units and determining how much that buyer could afford. If you'll recall from the 410 class, we had a lender analysis worksheet that we worked through to see if the buyer could afford the home they were looking at based on their income and other fixed obligations, or whether a home buyer subsidy was required in order to make that home affordable to the individual. On the rental housing class, your HD 420, we basically looked at how to calculate the amount of private debt, in other words, bank debt, that would be attracted to the project based on the lender's ratios and their parameters. We also looked at how equity is attracted to the deal based on the investor terms and whether those investor terms were based on a cash-on-cash or based on a tax credit cents per dollar or based on a more in-depth internal rate of return calculation. The next class, we'll use our computer spreadsheets to basically get through the same information, but much more quickly. The advantage of the spreadsheet is that it eliminates most math errors. So instead of doing many minute calculations, mathematical calculations, you can enter a limited amount of data and enter that data once and then make changes to that data, changes to the assumptions to see what happens to the project, whether it reduces the subsidy, increases the subsidy, or changes the amount of debt attracted or equity attracted to the project. So it allows us to very quickly see what the change of assumptions does in fact and the impact of those changes to the outcome of the project. So in brief, we're going to review some of the concepts from our previous two classes. Again, financing development of ownership housing, housing for sale to individual families, and financing the home buyer, and financing rental housing. When we're doing home ownership finance, there's three major things that are must-known. You have to know these three things, and those three things are cost, value, and affordability. The cost, we're really looking at what it costs to produce the product, to build the units, whether those are single-family units, condominium units, or some other type of housing unit. what is it going to cost to produce the product? The cost includes the construction and soft cost, our development cost, our profit as well. The value of the house once it's produced is not determined by cost, but rather determined by the marketplace. The appraiser will determine what the house is worth in the market, and that changes depending on where you are in the country. Value may not be the same in one part of the country as it is in another. In addition to that, we want to look at who wants to live there. In other words, who's willing to buy that house for that price, and how many particular families are available out there. We don't want to build a house and only have a very few limited persons available who can afford or who desire that house. We want to have a greater number of families desiring that unit of housing so that we have a larger number of potential home buyers out there for each product, each house we build. And then the third thing we want to make sure we understand is affordability. Can our targeted market, our families, afford this housing unit, this product? And if not, what kind of subsidies do we need to include in order to make this home affordable to that particular family unit? And as we've learned in our homebuyer class, the lower the income you're trying to reach, the more difficult it is for the family to afford the house, and then the larger the subsidy required to make the home affordable at that income level. Let's talk about the two kinds of lenders in a homeownership project. We have our construction lender, the lender that is going to finance the development of the units, and they're financing those units until they are ready to be sold to the home buyer. And the permanent lender. The permanent lender is actually providing the financing directly to the home buyer. And that lender, the permanent lender, is oftentimes called the takeout lender because it's the financing of the home buyers that allows the construction lender to be repaid through the sale of the houses. And lending, as you all may know, is a profession that requires very low margins. There's not a lot of profit in lending. And because of that, lenders tend to be risk adverse. They can't afford to take much risk in lending and still provide a viable product. So it's a very low margin business. They can't afford to make mistakes. And so a lot of what we're talking about is what a lender looks at before they make a loan decision, whether that's to lend on construction or whether that's to lend to the home buyers for the units. Let's talk about the construction loan. Again, this is a loan to the developer or the contractor. This will have a specific term and a specific interest rate. Might be something of 18 to 24 months at an interest rate of 5%. During the term of the loan, the interest typically accrues on the loan. It may be capitalized, in other words, converted to principal as part of the construction process, and then that interest and principal would be repaid when the units are actually sold from the sales revenue of those units. One of the things we always ask ourselves when we're doing home ownership is if revenues will exceed our construction cost. And one of the things that the construction lender looks at is if they can be repaid from sales. If they're not going to be repaid from sales, then they're not likely to make a loan. Your sales revenue from the sales, therefore, is going to go directly to the construction lender when sales occur to pay down that construction loan. So at the point where all the units are sold, the construction loan should have been well paid off. One of the exceptions to that is if the construction lender allows for a release price, and that would mean that the construction lender would take the majority of the sales proceeds, but maybe not all, allowing the developer to take a small profit for each sale. But the majority, again, of the sales price would still go to the lender to repay the construction loan. For example, if the home sold for $150,000, the construction lender might ask that $145,000 of the sales price be applied to the construction loan $5,000 would then go to the developer as a small percentage of their profit until all of the construction loan is repaid. But in most cases, the developer only makes a profit if sales revenues exceed total cost, and that construction loan and all other costs are paid back in full. If revenues are less than the total cost, then we would need what is called a development subsidy, a subsidy that goes for the project. It's a subsidy that would never be repaid. It's really a subsidy into the ground. In other words, nothing is left to repay that subsidy if there's a developer subsidy. It's not a deferred loan. You've sold all the collateral. That subsidy is basically a grant to the project. Our developer is typically going to want a profit of at least 10 to 15% of the sales price in order to undergo the risk it takes to do this type of development. In addition to a profit margin, a paid developer fee of 10 to 15% also allows us some margin of error in case the sales price of the house goes down at some particular point or cost increase. Then part of their profit would be reduced. But it allows us to look at some margin for error in case things go wrong before the developer has to go into their pocket for additional cash. So of those things, we have two key financial questions. The first, is the development profitable? Again, will revenues exceed expenses? And if they don't, again, we know that the development has to be subsidized. There's really a second key financial question, and that question is, will there be sufficient cash flow to meet our expenses when they occur? When we look at the profit and loss statement, we can see that at the end of the project, maybe the project is profitable, but it doesn't tell us whether 6 months into the project or 3 months into the project, we've got enough cash from either debt we borrowed from the bank or from equity that we're providing to the project to pay our monthly bills. So profitability and solvency aren't the same. The profit and loss statement tells us if the project is profitable, but it doesn't tell us whether we can pay our bills when those occur. We also know that some of that front-end cost is more difficult to finance. Those things are pre-development costs, maybe some of our design work, maybe even acquisition of the land, doing our plans, getting our permits. Some of those things are more difficult to finance, and we need to make sure that we have funds available to fund those costs. So one of the disadvantages of the profit and loss statement is it doesn't reflect timing. And you see an example here of the profit and loss statement that we used in our HD 410 homeownership class. And nowhere on this form does it tell us whether we've got enough cash in month 2 to pay some of that pre-development cost, or when the revenue from the sale of those units actually occurs. To do that, we need to look at something that allows us to reflect timing. The limitation of our profit and loss statement is that it ignores timing. It's as if the project is completed. So the cash flow analysis allows us to include expenses when they occur and include the revenue when we will see that revenue. We're going to break it up into what we need cash for and the various things: buying land, paying pre-development cost, getting permits, maybe purchasing the bricks and mortar or the sheetrock for the project, paying our subcontractors, and paying interest on our construction loan. We also have a number of sources of cash which can fund those cash needs. Our loan, hopefully from a bank or maybe a public source. Some supplier credit. If the lumber yard is giving you 30 days to pay, then that becomes a source of cash to help finance the development. The sales of the individual units is a wonderful source, and one of the reasons we typically stagger construction of homeownership units so that we can use the revenue from the sale of those units to help us finance the project. And then there's equity from the developer, from the owner of the project. also to help finance the project. So the cash flow statement, again, helps us identify when those cash flow needs are needed and what our sources are to meet those needs. So it quantifies the data with relation to time. All revenues and costs shown in the time in which they will be received. The limitation of the cash flow statement is really the assumptions. The better your assumptions, the better your information you will get from your cash flow statement. If your assumptions aren't accurate, the cash flow statement won't be accurate either. The nice thing about the cash flow statement once we get to the computer spreadsheet is that it makes it very easy to change these assumptions over time. If you realize that it's going to take more than 1 month to sell the unit, you can quickly make an adjustment to that and see what happens to the project profitability as it takes longer to sell. Or maybe you have to reduce the price of the unit in order to achieve those sales, and you can quickly see, again, the effect on the subsidy required or the profitability of the project as you make those changes. So the computer spreadsheet, we can see what changes in cost and quickly look at those changes and, again, how they affect the project, changes in the sales price, changes in when those sales occur, changes in the construction interest rate. And we can put all of the information into the spreadsheet fairly quickly and then make changes and see what those changes are. I'm going to take just a minute and pull up our single-family spreadsheet. I'm going to share my desktop with you and pull up that spreadsheet. And this is the spreadsheet for homeownership. This is our development budget. And you can see in this example, I've got land acquisition of $200,000, and we've got unit construction of $3.9 million. And let's scroll down to the bottom of the spreadsheet, and you'll see where that $3.9 million came from. We're going to build 30 units at 1,000 square feet. The cost per unit is $130 per square foot. So our units are going to cost us $130,000 per unit to build, and then our sales price is projected to be $180,000 per unit. Let's scroll back up to the development budget. And you can see we've entered some of the other soft costs, our architectural fees, our survey. We've also got our finance cost. Our construction interest is now calculated, actually not the same way we did it in our week 1 class, estimating construction interest, but it's going to calculate it directly off of our cash flow statement. And we've got other construction costs, construction insurance, property taxes, a little bit of marketing money for a total development cost of $4,648,000. If we look at our cash flow statement, I'm going to scroll over to it. We can see here there's our construction cost, $130,000 per unit. It's going to bring in our sales price of $180,000 per unit, and then we've got a commission paid to the realtor of 4%, our construction interest rate of 6%. And in this example, we've got 6 months to construct. This example is actually 5 buildings, 6 units each, and it's taking us 6 months to construct each unit and then 1 month to sell. So we can now look at our cash flow statement, and we sell our last unit in month 13, and that gives us a profit of $536,000, which is close to 10% of the sales price of the individual units. Now, the beauty of the spreadsheet is in being able to make changes to the assumptions very quickly. And you can see we've got the information that we input is the white cells. Everything else on this spreadsheet is a formula, and so there's very quickly you can enter the data and see what the results. Let's click over to the development budget again, and let's look at what happens if we change our sales price. Let's say the market weakens at some point during the project, and we have to reduce our sales price. We can change that. So it's now $170,000, and we can go back to our cash flow and then see what happens to our profitability at that lower sales price. And instead of a little over $500,000 in profit, our profit has been reduced to $245,000. So again, very quickly we can see what a change in sales price would do. Let's make a change to the construction interest rate. And let's say we've got a floating interest rate, and the interest rate goes up before we have a chance to start our project, and that rate changes to 7%. We can see again our profit went down by about $9,000, from $245,000 to $236,000. So we can see what an increase in the interest rate would be. We also can tell the amount of equity that would be required to do the project, $961,000 with these assumptions, and the amount of debt it would take to do the project. And we'll scroll across to the largest amount here, and that's $2,361,000 is the amount of debt it would take to undertake this project, again, based on these assumptions. So it's very quick to make and change assumptions. And then there's a profit and loss statement that also just summarizes the information that we have. Our total development cost, $4.6 million. Our profit, now with the higher interest rate and the lower sales price, down to $236,000. And if we wanted our developers to make a 10% profit, we can enter that information in this spreadsheet, and we wanted a desired profit of 10%, which was $510,000. At $170,000, we only made a profit of $236,000, so it would require a development subsidy of $273,000. Let me take a moment. I'm going to go back to the presentation and see if anyone has any questions so far. All right, I don't see any questions.
Nope, I don't see anything yet either, Stephanie.
If you have any questions, feel free to write them in the queue, or to, again, show the hand icon, and we'll identify you and try and answer your questions. Let's talk about the mortgage loan. This is the next phase of a single-family project. We want to look at the mortgage loan, and that is financing our home buyers. Again, this is the loan that is used to repay the construction loan. When the home buyers get financing, the proceeds of the sale of the units go to pay off the construction lender. So this is the loan to the home buyer, and it pays off the construction loan. This is our long-term financing for the project. This loan is repaid through monthly debt service payments. These payments are made each month, and they repay a portion of the principal on the original loan plus interest to the lender on that loan. And you can use your financial calculator to calculate debt service, or you can use the mortgage constant, which is what we used in our Week 1 and Week 2 class if you did not have a financial calculator. Now, we know that housing costs are more than just debt service. Housing cost also includes other payments. It includes that principal and interest payment on the mortgage, but it also includes a payment for annual taxes. In addition to that, it includes a payment for property insurance. This is the casualty insurance, and it may need to include mortgage insurance. either private mortgage insurance on a conventional loan or a mortgage insurance premium on an FHA loan. So principal and interest on the mortgage, and then taxes, annual taxes, and annual insurance payments. A portion of each payment goes to pay those expenditures. When a bank is looking at qualifying the home buyer, they're going to look at their lender ratios, and they're going to look at primarily four things. They're going to look at the loan to value, the amount that they're going to be willing to finance of the purchase price of the house. They're also going to look at housing expenses that PITI compared to gross income, and we call that the first ratio. And they'll look at fixed payments. Fixed payments are reoccurring debt to income, or total debt to income, which we call our second ratio. They'll also look at the credit worthiness of the buyer, basically looking at the buyer's historic history of paying their bills on time, whether they've been at their job for a significant period of time, and maybe whether they're a homeowner now or have been in the past. And all those things go into determining the credit worthiness of the home buyer. Part of qualifying the buyers that we've talked about in the previous classes is making sure we understand our target market and what income group we intend to reach. One of the nice things about the newest federal program out there, NSP, is it does allow us to reach a higher income home buyer. We can now help and assist home buyers at greater than 80% of median up to 120% of median through the NSP program. So it allows us to expand our targeted market from families that are making a little bit greater than 80% of the median income. Or we can always use the other programs, Community Development Block Grant or homeownership or other state and local programs to help finance the home buyer. Again, we want to look at the first thing the bank takes into account, and that is the loan-to-value ratio. They're going to finance a percentage of the fair market value of the home or the purchase price of the home. With conventional financing, we're typically talking about a loan-to-value ratio of no greater than 80%. So, quick example, if the home appraised for $100,000, the bank would be willing to finance 80% of that, or $80,000. With private mortgage insurance, maybe the bank is willing to finance a greater percentage of that because they're taking less risk, and they would finance 90% loan-to-value, or $90,000 of a $100,000 house. If you've got other government programs like FHA or some of the other federally backed programs, then perhaps the bank would be willing to finance an even larger percentage of the purchase price of the house. The other thing we want to think about when we're looking at loan-to-value is financing some of the other costs, maybe points on the mortgage, possibly whether the lender is willing to finance closing costs, and what prepaid expenses or other escrow items are required by the lenders as part of the closing process. The housing cost to income, which we call the first ratio, or sometimes it's called the front ratio, is going to be somewhere around 28 to 30%. That's probably where it is today for most underwriters that are providing homeownership finance. And they're going to be looking at income that includes full-time salary. It could include part-time or overtime pay if it's consistent. In other words, if they're consistently getting overtime or they're consistently working part-time hours over the last 18 to 24 months. It may also include other types of income like retirement or Social Security income, child support or alimony income that they're receiving. If the homebuyer is self-employed, typically they're going to look at the business income, less expenses, and the underwriter will review tax returns for the business for the last 2 years. If we're looking at the second ratio, or sometimes we call this the back ratio, then the lender is going to allow for a greater percentage of income to be used to cover housing cost plus other reoccurring debts. And so we're going to look at a maximum of 33 to 41%, and that's going to be 33 to 41% of all of those incomes that we just went through. And we'll need to cover all of our housing expenses, our PITI, plus other fixed loan payments, like a car payment or a student loan payment, credit card payments, alimony that the home buyer is paying to someone else, or child support that they're paying to someone else. It may also include daycare costs, which can be a large cost for a young family, or job-related expenses like union dues or uniform fees. So those are the reoccurring monthly fees that we want to cover with this second ratio or back ratio. The home mortgage is, of course, secured typically by the home that is being purchased, and the lender is going to determine how much of the home buyer's own money must be used in the purchase, and basically it's the reciprocal of the loan to value. If the lender is willing to finance 90%, it means the home buyer needs to come up with a 10% down payment. But that's going to change based on the loan product and by the lender. In addition to that, the interest rate charged by the lender will depend on the lender, whether that interest rate is fixed, whether it is a floating rate or an adjustable rate mortgage, or it's going to vary directly with one of the indicators like prime or LIBOR. The other thing that the lender will determine is the ability to finance loan cost, to finance some of those closing costs, those points, or maybe willing to finance some of the prepaid items. In a conventional mortgage, again, the bank is typically willing to finance 80% of the sales price or appraised value, whichever is less, unless there is mortgage insurance. If mortgage insurance is included, then the lender will be willing to finance a little greater percentage. So the down payment with an 80% mortgage is going to be 20% of the purchase price. And some lenders will allow that 20% to come from a gift, or someone in the family is providing the down payment, so it could come from either the buyer or from other resources. And typically there's going to be an origination fee, 1% of the cost. So again, on a $100,000 mortgage, 1% origination fee would be $1,000. And that will vary by market, and it changes over time. Again, with mortgage insurance, they would qualify, the home buyer could qualify for a larger percentage of financing, maybe up to 97%, because the risk is really being transferred to another party through private mortgage insurance or one of the government-backed security programs. Now, again, what the computer spreadsheet allows us to do is to look at assumptions, change assumptions with interest rate, change assumptions looking at the income of the home buyer, maybe looking at different loan to values, whether the bank finances 80%, 90%, or something higher, and looks at the buyer's monthly obligations. What do they qualify if they buy this new car? It reduces what they could pay for in a mortgage, and changing then the front and back end ratios that the bank's willing to finance. I'm going to share my desktop with you once again. And pull up this is the home buyer worksheet in the computer spreadsheet. And I've got an example here. We've got a purchase price of a home at $180,000. Our home buyer has an annual income of $50,000. They've got annual taxes of $1,800, annual insurance, of 1,000, credit card debt of 5,000, and we've got our front ratio at 29 and our back ratio at 40%. On a 6% 30-year loan at 95% of value, we can see how much the bank would be willing to finance. We've got input here, or a place to input other housing cost, and this would be like a condominium fee or maybe a mortgage insurance premium, and you would put it into this blank line. And it tells us, based on the front ratio, they could afford debt service of $875 a month. Scroll down and look at the back ratio, and they get a higher percentage, 40% of their income, for housing cost and other fixed payments. We've got our taxes and insurance subtracted out, or other monthly housing costs, and then a loan payment. And again, this could be for a car or a student loan or something else that they have a reoccurring payment for. And with the back ratio, it now tells us that the maximum monthly debt service is $863. So this is the more limiting of the two ratios, and it will be what the bank would be willing to finance. So the maximum debt service is your $683, and the maximum amount that you could finance is $113,974. The maximum amount based on a loan to value is much higher, $171,000, but the maximum loan for this home buyer, because of their income and their reoccurring debts, is only $114,000. We can now see that if the home buyer has, let's say they have 5% available for a down payment, which would be $9,000 on a $180,000 house, they would need a subsidy of $57,000, fairly substantial subsidy at this income. If we were able to use a higher income, let's change our income from $50,000 to $60,000 and see what the mortgage they could afford would change to. And we can now see that the maximum loan is very close to the maximum that the bank would lend on the house. It's now $169,000, and with a $9,000 down payment, the home buyer would only need a subsidy of about $1,400 in order to afford this particular mortgage. If we wanted to get to a lower income family, we could look at $40,000 in income, and at $40,000, our home buyer can only afford a mortgage of $58,000. They would need a subsidy then with a $9,000 down payment of $112,000. So one of the things you could quickly tell is at $50,000, they need a substantial subsidy, $50,000 per unit. But at $40,000, it's almost double that. So either we can finance a limited number of persons at $50,000, or an even more limited number of families at $40,000, or we could do a mix of the two. But with our limited funds, we can now see how many homes we could target to potential income home buyers. And let me pause again as I go back to the presentation and see if there's any questions. I know several of you had questions about the presentation, and I think Jenny's been right on those. You can download the presentation and so forth. Are there any other questions at this point?
Looks like there are two in the queue.
Okay.
And I'm probably going to butcher the name. Is it Nini? If you could just unmute your phone and you can ask your question. You want to right-click on your name and just select unmute. Hello?
And you're unmuted, Nene. You can ask a question now.
see a couple of questions down.
Maybe she walked away. Is Emmanuel there? Can he be unmuted?
And what's the last name?
Bell?
Hello? Go ahead, Emmanuel.
Well, I think at first Jenny did answer my question. I really I wanted to have the spreadsheet with me while you were kind of going at it to also play around with some numbers, but I just emailed that email address that she sent me to get a copy of the spreadsheet. So right now I'm following along.
Okay. Well,
so I
appreciate your question, and certainly as you enroll for the HD 422 class, we will be sending out both the single-family home ownership spreadsheet and the rental housing spreadsheet, so that you have plenty of time to do that. And as with all NDC classes, we'll send you a nice pre-session assignment that you can test your knowledge of those spreadsheets ahead of time before the class starts with a case study.
Okay, excellent. Thank you.
Great. Any other questions? All right. Let's talk about rental housing finance. And going back to your HD 420 class, one of the things that we really did with our introduction to rental housing finance is we taught you how to calculate a gap in your project. And we started with the formula. We're looking at the cost of the project, your development budget, how much it's going to cost to develop the project, construction cost, other soft cost, financing cost. And then we looked at, again, how much debt you could attract to the project based on the lender's underwriting, using a debt coverage ratio and a loan-to-value ratio. We also looked at how much equity you could attract to the project based on one of the equity investors' parameters, whether that was cash on cash, which we use that little e to represent the cash on cash return that the investor wants, whether we're attracting equity based on tax credits, and we'll touch on those tax credits again today, but basically pricing the tax credits on so many cents on the dollar to attract equity. And then your internal rate of return, which again is a more complex calculation of equity attracted, which includes all of the benefits of owning real estate, the cash flow derived from the project over time, the tax benefits through tax credits and depreciation and other losses, and then appreciation, which is the residuals from the sale of the property sometime in the future. And as with all of these ways you attract equity, it depends on the investor. And with most of our projects, there may not be a huge amount of cash flow to attract equity, and the internal rate of return, because it includes benefits that may not occur for many years and includes appreciation, which may or may not occur on many of our projects, most of our projects will attract equity based on tax credits. If we look at our net operating income, that's going to be the major factor in determining what attracts bank debt, permanent debt to the project. In our formula here, we're going to start out with our gross revenues, our rents from the project, plus any miscellaneous revenue, maybe some interest on reserves or fees the tenants pay for late charges. And we're going to subtract from that a vacancy or a collection loss. And typically that is never going to be less than 5%. On our standard affordable projects, you'll see the vacancy typically calculated at 7%, but it's likely never to get less than 5%. Even on projects that are 100% occupied, you have some vacancy as tenants move in and out. The gross rents less our vacancy gives us our effective gross income. And then we want to subtract out operating expenses, everything from management fees, general admin, maintenance cost, utility cost, and insurance, etc. In addition to that, there may be a requirement for replacement reserves, an amount that's deposited each month into replacement reserves to cover large capital items when those occur, like the replacement of a roof, the replacement of an HVAC system, or something major. And that leaves us with net operating income. And again, net operating income, very important number because it is really the number that tells us how much cash we have available to repay debt and how much is left over then to attract equity. So it's the overall return on all invested capital, both debt and equity. Let's look at a hypothetical example. Sunnyview Apartments. It's going to cost $2 million to construct the units. We've got 20 apartments. They will rent at $850 per month. We've calculated a 5% vacancy rate, and our expenses and reserves are $3,850 per unit per year. So we've got gross income at $850 a month times 20 units times 12 months gives us $204,000. We subtract 5% vacancy from that. It gives us effective gross rents of $193,800. Subtract out our expenses of $3,850 per unit times our 20 units to get $77,000, and that leaves us with a net operating income of $116,800. The net operating income is going to be what the appraisers use to determine the fair market value of the project. So if we start with a net operating income of $116,800 in an area where the market capitalization rate is 8%, we can derive the fair market value, and that comes to $1,460,000. Now, market cap rates are typically provided by appraisers. They keep track of sales in the marketplace, and through the tracking of sales and the operating income of those sales, they can derive a cap rate that is typical in the marketplace for a typical type of real estate. Cap rates do change over time, and they also vary by metropolitan region, where you are in the metropolitan region, and certainly by geographical location. Typically, cap rates are going to be lower in stronger markets, like on the two coasts, the East Coast and the West Coast, and higher in weaker markets like the industrial Midwest. Let's look at loan-to-value. The loan-to-value limits the amount that the lender would lend on the project based on its fair market value. And in this example, the lender's loan-to-value is 75%. So if we look at the fair market value that we just calculated, the $1,460,000 times the lender's loan-to-value ratio of 75%, 0.75, it means the lender would be willing to lend $1,095,000 on this particular piece of property. That's what we call the collateral risk. They're lending a percentage of the collateral, 75% of collateral. It's a way that the lender could be repaid in the event of foreclosure. If they foreclosed and were able to sell the property for at least 75% of value, that would repay their loan in full. More important to the lender is really the maximum that the project can afford to repay based on operating income. If the lender has a debt coverage ratio of 1.25, we see the formula here for calculating the maximum debt service based on a debt coverage ratio of 1.25. NOI divided by the debt coverage ratio gives us our maximum debt service, principal and interest payments on a loan on an annual basis. So if I've got a net operating income in this example of $116,800, we'll divide it by the lender's debt coverage ratio, and that gives us $93,440, which is the annual debt service, principal and interest payments on a loan. We need to go to the second step, which takes debt service divided by the constant, and in this case we're using the constant for a 7% loan at a term of 30 years, and that constant, 0.0799, means that the lender would be willing to lend based on a debt coverage ratio, 1,169,000. In other words, this is the amount that the bank feels that the project can repay from rents from the project after it's paid expenses. If we look at the two loan amounts now, based on loan to value, the bank was willing to lend $1,095,000. Based on the debt coverage, the lender would be willing to lend $1,169,000. What the lender's going to choose is the loan amount that is the lower of the two, or the loan that basically qualifies under both ratios. And in this case, the more restrictive loan amount would be based on the $1,095,000. So we want to calculate debt service now on the $1,095,000 at the constant, and that gives us a debt service of $87,490. And this is the amount then that would be used to repay the bank back monthly debt service payment, but it's a calculation for annual debt service. Now, one of the other things that we talked about in our HD 420 class was stabilized NOI. And stabilized NOI is something the lender uses to basically give you the benefit of lease up. If you've got a project and it's going to have higher vacancy in the early years as you lease up the project, it means that the net operating income for those years is lower than it would be if you had leased up the project and reached stabilized vacancy. So stabilized NOI simply gives you the benefit of lease up. We're going to look at gross revenues from the first year because they're the easiest ones to predict, and we'll use our stabilized vacancy rate for the year in which vacancy actually stabilizes. In an example, let's say the vacancy rate is 25% in the first year as we go out and market the project, but maybe in years 2 and 3 that vacancy rate drops to a stabilized 5%. So we would use year one's gross rents, but the 5% vacancy rate to come up with effective gross income, subtract out year one's expenses, again, more known, and the replacement cost, replacement reserves required by the lender to come up with a stabilized NOI. And it's this number that the lenders will use to calculate the loan amount based on the stabilized NOI, and it's the stabilized NOI that the appraisers will use to calculate a fair market value. Any questions? Again, I'll pause.
Doesn't look like it in the queue. If Emmanuel, if you could deselect your hand so you're out of the queue. And then I'm not sure, thank you. And then I'm not sure if Nini's back. If she has a question or he has a question. Doesn't look like it, Steph.
Okay.
Up there.
Let's look at what an investor looks at when they invest in a real estate project. Investors invest for something called return on investment. When we're looking at a non-tax credit project, that return is typically going to come from the cash flow generated by the project and potentially appreciation at the sale of the unit. When we're talking about our tax credit projects or our affordable housing projects, that return comes primarily from tax benefits such as low-income housing tax credits. Let's look at the ways investors invest in real estate projects. The simplest way an investor looks at a project is called the cash-on-cash rate of return. And again, this is what we choose to use the little symbol E, little e, to show the cash-on-cash rate of return required by an investor. And we can calculate their return by simply taking the cash flow from the project, dividing that by their equity investment, and that tells us the return that they are able to receive. It measures the return on a non-tax credit project because it's not taking into account any of the tax benefits of the project. Let's look at our example project again. In Sunnyvale, we had a NOI of $116,800. We calculated debt service on our smaller loan of $87,490, and that left us with cash flow of $29,310. If the market cash-on-cash rate of return is 8%, we could calculate how much equity we could attract to this project. And in this case, about $366,000 would be attracted based on an 8% cash-on-cash rate of return. If you recall, this was a $20 million project. It was going to cost us $20 million to build. We got just under $1.1 million in bank financing, and now we're attracting equity of $366,000, which leaves us with a gap of over $500,000 that we would need to fill. So this is a project that we would say cannot attract enough capital, debt, and equity to finance the entire project. And it would need some kind of subsidy, or in many cases, this is a project that just would not get built without other incentives. Let's look at the loans that are required to finance rental housing. Again, we have permanent loans, and these are our long-term loans, usually 15, could be up to 40 years to finance the project. And this is the loan that is repaid from rental income derived from the project each year as time goes by. There's also a construction loan, the short-term loan, usually less than 2 years, which finances the project while it's under construction during the development phase and until you get to a takeout by the permanent lender. So it is repaid then from permanent financing sources that could include the permanent lender repaying a portion of the construction loan. It also may be repaid from a large equity investment from your tax credit investor. Typically at completion, your tax credit investor will invest a large percentage of the equity that they have agreed to provide, and that will be used then to pay off the construction loan. Our permanent lender, when they're looking at financing a project, is going to look at debt coverage as the primary way to be repaid. We talked about the fact that they would be willing to lend based on a loan-to-value, and that loan-to-value is what, in fact, pays them back if they have to foreclose. Lenders would prefer not to be paid back through foreclosure. They want to get paid back through profits from the development, your net operating income. And so debt coverage ratio is considered the first way out. It's how the lender is repaid based on net operating income. And again, typically 1.2 or higher would be a good debt coverage ratio. That 1.2 really provides the lender, again, with a margin for error. If net operating income goes down, that you would still have enough net operating income to repay debt service. So this is really telling us that we have $1.20 in net operating income for every dollar in annual debt service on the project. So if net operating income went down by 20 cents, you'd have a debt coverage ratio of 1 to 1, but still enough money to repay the lender. You just wouldn't have anything left to pay a return to the investor at that point. The debt coverage ratio really assesses credit risk. The loan-to-value assesses collateral risk. And again, this is considered the second way out if the project is unable to repay the debt based on cash flow and the lender has to foreclose. They have to foreclose on the asset, and then they sell the asset. They hope that sales price then at foreclosure is higher than the loan balance and they can be repaid. So a typical loan to value is going to be 75 to 80% or less. And again, the lender's just looking for enough in resale proceeds to repay their loan. The construction underwriter, when they're looking at a project, they usually don't approve the construction loan until you have a permanent loan in place, because they want to know that that permanent loan is in place, and in fact, when it is issued, the permanent loan is in place, then the construction loan is repaid. But during construction, they're also looking at some other issues, and some of their key concerns are going to be the developer's strength, their experience, their capacity to deliver this project as planned. So if this is a developer that has done this type of project before, that is willing to guarantee completion to the construction lender, that has a fairly strong financial statement to cover things with their own cash if things go wrong, then the lender is going to look at that as a strong developer. If, on the other hand, the developer hasn't done this type of project in the past, it may be something of a new experiment with the developer. Like a lot of our nonprofit developers, they may not have as much strength on their balance sheet, then it's going to take more scrutiny by the construction underwriter before this particular developer is provided a loan. One of the ways to offset a lack of strength of the developer is a very strong general contractor. And again, we're going to be looking at many of the same things we look at with the developer. Their strength, their experience, have they done this type of construction before? And the lender is going to lend a percentage of that construction cost. So again, they have collateral coverage during construction. They're looking at the general contractor. The general contractor may, in fact, have provided the developer owner with what's called a gross maximum price contract or a fixed price contract. So if there's cost overruns, rather than the developer having to pay for those, it's really the responsibility of the general contractor to cover those cost overruns. Again, we're looking at their track record, their experience, and their ability to fund those cost overruns out of their cash, the general contractor's cash. In addition, we're going to be looking at the permanent lender's conditions for funding. What kind of occupancy do we have to reach before the permanent lender comes in to take out the construction loan? We're going to be looking at maybe they have to reach break-even points for a certain period of time, or they have to reach a certain level of profitability before the permanent lender comes in and funds the permanent loan. The construction lender will also look at the line items in the budget, just making sure that there's enough budgeted for all of the components of the construction cost, not just construction, but they want to make sure you've got an adequate budget for construction interest, to pay your soft costs, your architectural costs, design fees, and so forth. And they want an adequate contingency, a margin for error when things don't go as planned. And that construction contingency may vary depending on the type of project you have. A 5% construction contingency may be adequate if we're talking about new construction. If we're talking about a rehab, because there's oftentimes hidden conditions that we don't know about when we're doing our budget, typically the construction contingency would be higher, maybe as high as 10%. In addition to the construction contingency, the construction lender is going to be looking for the potential for a payable development fee. In most of our tax credit deals, there is a development fee in the budget, and as long as that is payable at completion, in other words, it's not deferred, then it basically serves as additional contingency for the project. If things go wrong, if we go through all of our construction contingency and we still need additional funds to complete the project, then the developer would use part of their paid developer fee to fund those cost overruns in that likelihood. So those are just some of the things that the construction lender would be looking at. Tax credits. For most of the projects that we'll do as rental housing, there are three primary types of tax credits that we can access. And these tax credits are a dollar-for-dollar reduction in the tax liability of the owner of this real estate. The first tax credit is the historic rehabilitation tax credit. The second is the low-income housing tax credit. And then there's also a third type of tax credit, the new markets tax credits, which could be used on residential projects if there is a large commercial component or a significant amount of commercial revenue. The investors for the majority of these projects are going to be large corporate investors, and they're primarily going to be banks. Our historic credit. The historic rehabilitation tax credit is a one-time credit on the qualified rehab expenditures or the rehab costs that are eligible. It's a 20% one-time credit, and in order to qualify for this credit, the building must be a certified historic structure. And there's two ways to qualify as a certified historic structure. The building can be a contributing building in a National Register Historic District, or it could be individually listed in the National Register itself. Either way, it could qualify for the 20% credit. You can take the 20% credit on the project if it's a commercial building, if it's an industrial building, or if it's rental housing, but you can't take the federal historic credit for homeownership housing. There are a number of state programs that offer historic credits, and there may be some states that offer a historic rehab credit for homeownership. The federal government currently offers this credit only on income-producing property. For the credit to be accessed, the project has to reach what's called substantial rehabilitation, and that's pretty simple. Either they need to spend the greater of $5,000, a very low amount today, or $1 more than the property's adjusted depreciable basis. And all that means is what you paid for the project when you bought it, less what you've depreciated or written off through depreciation over time will give you your adjusted depreciable basis. Once you've spent more than that, you can count the entire amount that you've spent on rehab that is eligible towards this credit. Let's look at what is included in basis. The basis for calculating the historic tax credit includes all the costs below that are part of the depreciable basis except for your building acquisition. So your construction cost, and that's your rehab construction cost, any of your construction financing cost, taxes that are paid during construction, your soft cost, architectural, engineering, design fees, fees that are paid to your builder, your developer, appraisal, and other costs, again, that are capitalized and depreciated over time as part of the building. What is not part of basis for the historic credit, any acquisition cost, which would include the building, any costs that are amortized rather than depreciated. So this is your intangible assets like your loan fees or your tax credit fees. In addition, if you've got new construction that is part of the project, none of the new construction costs are part of the basis for the historic credit. If the new construction is outside the walls of the historic building, it's not includable. If you basically do demolition to the interior of the building, that's part of basis. Demolition outside of the building, again, not part of basis. The historic credit, we mentioned it's a 20% one-time credit. It is taken in the year that the building is placed in service so that you get your certificate of occupancy on the project. That's when you can take the credit. It does require a 5-year compliance period, so the ownership of the building can't change for 5 years without recapture of a portion of the tax credit. And one important piece to note is whoever owns the building at the time when it's placed in service is really who gets to take the credit. Oftentimes, a nonprofit or maybe an individual may own the building. They don't have the ability to take the credit, and that's when you need to syndicate the ownership. And that ownership then cannot change for 5 years. The second credit I want to talk about is the New Markets Tax Credit. It's a newer tax credit. It was designed to increase investment into low-income census tracts, and it can be used primarily for economic development type projects which are going to create jobs, or develop additional business opportunities within a low-income census tract. With New Markets Tax Credits, like other tax credits, the investor is going to get the tax credit, but the business or the project will get either equity or a loan that will be forgiven over time or treated like equity over time, or they might get a lower interest loan, a lower market, below market rate loan. Because it is primarily an economic development credit, it can't be used for a project that is 100% housing, but it can be used for a project that is mixed use, or in which, again, there is a large commercial component and more than 20% of the gross revenues of the project comes from non-residential activity or commercial activity. Then it would qualify for the New Markets Tax Credit. The New Markets Tax Credit is based on what's called a qualified equity investment. It's not a basis tax credit, and so you can use the money that is derived from a New Markets Tax Credit to finance any part of your project. It doesn't matter what you're financing. The investor would provide the equity in exchange for the credits. The credits are a total of 39%, and they occur over a 7-year period. In years 1 through 3, the credit is 5% to the investor each year for the first 3 years. It is 6% per year for years 4 through 7. So first 3 years at 5%, 15%, 6% for the next 4 years, or 24% for a total of 39% over a 7-year period. And New Markets Tax Credits, like the historic tax credit, is really a shallow subsidy. It's not going to make a project cash flow, but it may make a project, or it may fill a gap on a project. It can provide basically 16 to 20% at today's current rates of your total project cost in basically free money, money that would not be repaid, because the investor is getting their return not from the project but from the federal government through tax credits. The New Markets Tax Credit program is administered by a division of Treasury, the Community Development Financial Institution Fund, and it's awarded each year to certified development entities that apply to CDFI for an allocation of tax credits. So the tax credits are allocated to CDEs, not to projects. CDEs then take their allocation, and they will invest in projects in low-income communities based on their application to CDFI. New markets, unfortunately, cannot be combined with low-income housing tax credits if the project has the same ownership. You can change the ownership of the commercial and use new markets on that piece and low-income on the residential, but you can't have the same ownership for both pieces and combine the credits. You can, however, combine new markets tax credits and historic tax credits in the same project, And you can combine historic tax credits and low-income housing tax credits in the same project. Low-income housing tax credits, you may be familiar with. It is a 10-year credit. It's an annual credit for 10 years, but the projects must qualify on 3 separate criteria: the income and the occupancy of the residence, the rent that is charged on the residential units, and then must get the state approval through an application process. There are 2 ways to qualify as a low-income project, and these are definitions provided by the Internal Revenue Service. If 20% of the units are occupied by tenants with incomes at or below 50% of the area median income, then it's considered a low-income project. Or the developer could choose the second definition of low income, which is 40% of the units must be occupied by tenants with incomes at or below 60% of the area median. And for practical purposes, you only get low-income housing tax credits on the units that are low-income units. Most developments are 100% or close to 100% affordable, and so most developers will choose the latter of the 2, 40% at 60% of median, because it allows you a larger number of tenants basically with incomes that would fall into that range. But you can choose either one as a developer. With all tax credit projects, you do have rent restrictions. All of the LIHTC units have rent restrictions. If you have a mixed use or a mixed income project, you might have some market rate units which would not be rent restricted, but all of the units that you're receiving credits for would have rent restrictions. And those restrictions are based on the number of bedrooms in the unit. And the way this is done is by imputing a household size based on the number of bedrooms. If it's an efficiency unit, a 0 bedroom, the imputed household size is 1 person. If it's a 1-bedroom unit, the imputed household size is 1.5 persons. So if you've got a 2-bedroom unit, each bedroom with 1.5 persons, you basically would take the income for a 3-person family. And then rents cannot exceed 30% of that income qualifier, or the 3-person family, at either the 50 or the 60% rate, whichever was used by the development. The maximum rents then include all utilities except for telephone, so your heating and your cooling costs, the water, sewer, and trash, all get included as part of rents, or if the tenant is paying those costs, then the maximum rents are reduced. Maximum rents do not include rental assistance, such as Section 8, or payment for supportive services from a government or a nonprofit state or local agency. The maximum rents do include any tenant payments for services that are required. So if you think about an assisted living project, most of those projects require services, and there's fees for those services. And if you require the tenants to pay those fees, then those fees must be within the maximum rents. Or you can choose to make those services optional, and the fees paid for those services optional, and then those would not count towards the maximum rents. Any of the services that are paid for by other agencies would not be included as part of the maximum rent. Again, as long as a tenant can refuse services, it's not part of the maximum rent calculation. In 2012, the federal government allocated $2.20 per resident of the state to the state for allocation in low-income housing tax credits. There was a minimum for small states, and that's $2.5 million. Then the state agency is the one that goes and allocates the credits through a qualified allocation plan. And that plan has to require that at least 10% of the credits get awarded to nonprofits. And most of the states that I've worked in, they allocate a much higher percentage than that 10% to nonprofits, and it's become really a moot point, but there is a federal requirement that at least 10% go to nonprofit projects. In recent years, the qualified allocation plan by states needed to include energy efficiency. That was one of the federal mandates, and historic preservation. So in most states, what I've seen is they give bonus points for energy efficiency, or again for doing historic preservation as part of the project. You can use low-income housing tax credits for new construction or for rehab of a existing unit. It could be any kind of building as long as it's substantial rehab, and the definition's a little bit different for low-income housing tax credits. Substantial rehab is the greater of $6,000 per unit or 20% of the building basis. So with our rehab tax credit, you had to exceed the building basis. With your low-income housing tax credits, you just need to exceed the greater of $6,000 or 20% of building basis. And there's two types of projects and really two credit amounts. The 9% credit is the amount that you could take on all improvement costs that are not funded with tax-exempt financing. The 4% credit is on all improvement costs, regardless of the financing, and essentially this would be a tax-exempt bond deal. The 9% is currently fixed at 9%, so it's not changing, and there is legislation proposed to fix that percentage indefinitely. I think it's fixed right now at least through 2013. The 4% rate, however, does fluctuate, and it fluctuates on a monthly basis, and currently it's around 3.15%. So although we call it a 4% credit, it's really not a 4% credit right now. It's just a little over 3%. For some projects, they may be eligible for what's called a basis boost, and those are projects that are located in difficult-to-develop areas or high-cost counties, or perhaps a qualified census tract, a census tract where you have lower median incomes, or you have a higher percentage of households that are below the poverty rate. Qualifies the census tract as a QCT, qualified census tract. And if you're in one of those DDAs or QCTs, you can qualify for an extra 30%. So as an example, let's say you've got a $10 million project and you are located in a qualified QCT. So instead of getting tax credits based on your $10 million, you could get tax credits on a $13 million project, or a 30% increase in your tax credits. In addition, one of the recent economic development stimulus programs provided by the federal government gave state agencies the ability to increase credits to a project up to 30% in order to make it feasible. And so this is at the discretion of the state agency. You would apply for that typically when you apply for tax credits, ask for the additional boost to make your project feasible. The state agency can award credits anywhere up to that 30% or enough to make your project feasible. It may not need any of that 30%. It may not even need 100% of the tax credits that it qualifies for. So it's able to do that at its discretion. However, you cannot get the basis boost from the state agency on a bond project. You could get the basis boost on a bond project if you're located in a QCT or DDA. You would automatically get the basis boost, but you can't request it from the state agency. Let's look at what is eligible under the low-income housing tax credit program. We have improvement cost, and those include all of the things on the left-hand side: our construction costs, our permits, our property taxes, our bonds, our furnishings. Maybe we're providing some lobby furniture or some equipment in an exercise room, or a computer for our asset management company, and a developer fee, contingency that is spent. What is not included is really our intangibles. Again, the permanent financing fees, marketing fees, reserves, tax credit, off-site improvements, costs not related to the residential portion of the building, not used by the residents, or cost for market rate residential if you've got a mixed income project. Or, again, since this is a 9% credit, we can't include any costs that are paid with tax-exempt bonds. Notice that acquisition is not eligible for the 9% credit, but we can get an acquisition credit for the building of a 4% credit. I've got an example of that in a moment. Here's an example of a new construction project in a qualified census tract. And we've got land, $400,000. We've got our construction cost, $3,900,000, and $1 million for a commercial. It's got a commercial component, a mixed-use project, for a total development cost of $5,300,000. If we look at how we can finance this cost, we can look at our residential cost of $3.9 million, and since it's in a QCT, we get to multiply that times 130%, or 1.3, which means we've got a credit basis of $5,070,000. We're going to multiply that times our 9% credit rate for $456,000 in the maximum annual low-income housing tax credit. That for 10 years means we have $4.5 million in low-income housing tax credits at a credit price of 80 cents, which is a little low today, but very achievable. That would attract equity of $3.6 million. And so we can see from our sources of funds that that pays for more than half of our total project. So a project in a QCT is going to attract a considerable amount of equity through the low-income housing tax credit program. Here's a second example of a project with tax-exempt financing. Again, we've got $9 million in construction cost and $1 million in land for a total of $10 million. And we've got $9 million that is part of our low-income housing tax credit basis times our 4% rate, which isn't 4%. It's, in this example, 3.4%. And that generates $306,000 in annual low-income housing tax credits, again for 10 years, or a total of $3,060,000 at a credit price of 83 cents. It's going to generate $2.5 million out of our $10 million project. It's going to subsidize a much smaller percentage of the project than the 9% credit, but there are some reasons why a project might decide to use the 4% bond, 4% tax credits on a tax-exempt bond rather than a 9%. 9% tend to be very competitive, and the 4% bond, tax-exempt bonds, tend not to be near as competitive. It's much easier to get an allocation of private activity bond cap than it is to get an allocation of low-income housing tax credits. Again, we said that low-income housing tax credits in 2012 were allocated to each state at $2.20 per person. The private activity bond cap is allocated to the state at $95 per person. So much easier to get an allocation of bond cap, easier to get the 4% credits then to go along with the allocation of tax-exempt bonds. There's also an acquisition credit. It's an annual credit for 10 years, and it's the 4% credit on the building value owner only. The previous building owner had to have owned the building for at least 10 years, or you can ask and get a waiver if the project is a preservation project, if it has been receiving some sort of public federal assistance, such as Section 8. And again, this credit is available only with substantial rehab. And you can't get a basis boost regardless of whether it's a tax-exempt bond deal or a 9% deal on the acquisition credit, regardless of QCT or DDA or whether the state wants to give you additional credits. You can only get the 4% credit on the actual acquisition for the building. Here's an example. We've got acquisition, and we're going to impute half of that acquisition was building, and half of that acquisition was, in fact, land cost. So we've got $4 million of rehab. We look at our rehabilitation credit on the $4 million at 9% generates $360,000 in low-income housing tax credits. The building value, half of acquisition, at the 4% rate, which we're using 3.4 in this example, another $34,000 in LIHTC credits per year, so a total of $394,000 in maximum annual low-income credits, which at 80 cents would provide a little over $3.1 million in equity to the project. Now, let's talk about what the computer spreadsheet does for us with rental housing. With rental housing, it makes it very easy for us to change rents, to adjust expenses, to look at different vacancy rates, to look at different loan terms and loan offers from various banks. We can adjust the debt coverage ratio or the loan to value to see the amount of debt attractive. We can change assumptions in the tax credit amounts and how much the investor would pay based on the tax credits. And we could look at our mix of units, market rate units, affordable units in the project. I'm going to share my desktop again and pull up the rental housing spreadsheet. And this is the development budget for the rental housing spreadsheet. And you would input the information into the development budget. This is very similar to the black and white form you may have used in 420. So we've got construction cost, and we've got profit and overhead, some contingency, we've got some professional fees, and ultimately our total project cost adds up to $2 million. So we'll click over to our pro forma, and we'll see this is our project with 20 units. Our market rents are $850 a month, and that's going to generate gross revenues of $204,000 for the project. I've got a vacancy rate, a little higher vacancy rate during the lease-up year, and then stabilizing at 5% thereout. Look at expenses now. This was the same example we used earlier, and I've split the expenses out into operating expenses totaling $70,000, and then $7,000 of those expenses really go to replacement reserves for a total of $77,000 total. So based on these assumptions, we can now figure out how much debt might be attracted to the project, and we'll go to our sources of funds page. And let's look at our percentage of, let's see, our debt coverage ratio. We're going to use a 1.25 debt coverage ratio, and our loan is going to be based solely on debt coverage ratio. We'll use our terms of 30 years at 7%, and then based on that debt coverage ratio, it tells us how much debt would be attracted to the project. This was a $2 million project, so we would still need some equity in order to fill our development costs. Let's look at what happens if we change our rents to maybe a more affordable rent for a tax credit project. And we can go in, let's change our rents to $490. You can see our revenues have gone down substantially from the 204. And let's see how much debt we can attract now based on a 1.15 debt coverage ratio. Bank loan went down from over $1 million to $347,000. Much less, as we've got less income to attract debt to the project. If we want to finance this project now that we've got affordable rents with tax credits, we can input, here we've got a sale rate of 85 cents to attract equity, and we can see that our equity based on that sale rate is $1,357,000. So if we've got debt of $3,048,000, another $1,358,000 in equity, it leaves us with a small gap of $294,000. Maybe we put that in as a deferred loan, and that gets rid of our gap. So we can see very quickly how changing assumptions affects our pro forma. Let's look at what happens if this project happens to be in a boost area. And we've got a toggle for that under LIHTC bonus area. We're going to change that to a 1. That means I should get more basis, and I should get more equity. So let's see what happens to our equity amount. It goes up by about $400,000. If equity goes up by that amount, then we no longer need the deferred loan. And in fact, we've got some extra money for additional reserves, or our tax credits would be reduced by the allocating agency. So you can see very quickly how we can change assumptions and adjust those assumptions, and we can see what happens to the project based on that information. On the tax and appreciation benefits page, we can see clearly here this is a project now. It had $1,770,050 in rehab construction costs. At the 9% rate, we were in a boost area, so we got 130% of the credits. So we got more credits, $207,000, and those credits were calculated at 85 cents to get us the equity on our sources of funds page at $1,750,000. So that, in a nutshell, is the rental housing spreadsheet. And we've got, on the last page here, I think we've got some resources for you, but at this point I will open it up to questions from the participants.
Stephanie, there was a question that was sent in and says, what's the best method to shop for good LIHTC rates?
The best method to shop for good LIHTC rates. What I would probably do is see if your allocating agency has a list of syndicators with an interest in your region, and follow up with some of those syndicators. You can also talk to your local bank, see if they invest in low-income housing tax credits in your area. The other place you might go to is if you have a association of affordable housing providers. Use them as a resource to find out who is investing in your region on tax credits. A lot of investors may be nationwide. In other words, they'll invest in any state, but many investors actually invest for community reinvestment purposes, and therefore will invest only where they have a footprint, where they have an operating bank.
Right now, that's the only question. See if a couple more come through here. And if you have a question, you can submit it through the Q&A box, or just select the hand option, and we will unmute you to verbally ask your question. And all the information can be found on HUD's Resource Exchange. A copy of the presentation, the transcript will be there in a couple days, as well as a recording of the webinar if you want to re-listen to the entire presentation. So, Steph, I think that's it. Oh, it looks like we do have somebody that has a question. Get him unmuted. And
I see a couple of question from Michael Glasgow. Where can you find the census tracts that qualify for New Markets tax credits? There's a couple of places. One, you can go to the Treasury's website, and there's a mapping tool there, and the Treasury website is cdfifund.gov. CDFI, Community Development Financial Institution, the word fund.gov, and you can find the census tracts there. Or HUD actually has a mapping resource. I'm not sure I know what the website is for that. One of the places I often use is one of the accountants that do a lot of New Markets tax credit projects, and it's Novogradic, and they have a mapping tool and a link to a mapping tool, and their website is nvoco.com, and then you can go to resources page and New Markets tax credits, and to the mapping tool there as well. Jenny, did you
And Lynn, your line is unmuted. You may ask your question at any time.
I had a question about the training classes. I noticed the way the schedule was set up. You have not had the prerequisites. They didn't want you to take the other classes, but given the schedule, it's not really always possible to get one prerequisite before you could take the other one. So you have to have taken both the housing and the rental in order to take the computer spreadsheet analysis.
Jenny, I'm not sure I heard the entire question, but it sounded like a question regarding prerequisite requirements for these two classes. In general, these classes are going to build upon things that you should have already learned in the HD 410 and 420 classes, and so it is important that you've had the previous classes. I know that we have made exceptions on a limited basis where you may be able to take the previous exams, or based on your experience, maybe will allow you to test out. But in general, you would benefit yourself by taking the two previous classes.
Okay, thank you.
Do we have any other questions?
Stephanie, I just want to add that they can call the contact the NDC training office at 859-578-4850. Typically, though, she's right. These classes are prerequisites, and testing out of them typically isn't an option. But if it's a conflict in schedule, we might be able to work something out. And I don't see anything else.
All right. If anybody thinks of a question after this webinar, I would be glad to answer it. You can contact me through my NDC email address, which is sdugan, SDUGAN, at nationaldevelopmentcouncil.org, and I'd be glad to try to find an answer for you.
Okay, well, we appreciate everyone's time today, and hopefully you learned a little something this afternoon. I did type in Stephanie's email address into the chat box if you want to jot that down, or contact the training office, and we can also provide you with that information.
All right. Thank you, everyone.
Thanks, Stephanie.